In market news now, global stocks are headed for their best weekly gains since November on bets that the U.S. monetary tightening cycle is nearing an end. Investors got an extra dose of encouragement to bid up riskier assets after U.S. PPI reports highlighted the view that price pressures are easing in the world's largest economy. Meanwhile, locally, Absa expects an increase in credit impairments in its next interim results as consumers battle with high inflation and interest rate hikes. Last month, Nedbank said it expected bad loans to rise in the year under pressure from a worse than expected economic situation. Another local lender, Standard Bank, said its proportion of non-performing loans would rise in the interim period due to high interest rates and inflation, especially in its main market, South Africa. To give us more perspective, we are joined by Thato Mashego from Sanlam Private Wealth. Thato, thank you so much for your time. Before we start talking about the actual banks and touching on Absa's trading update, what's your sense of global market sentiment right now, especially as we look back on the week?
Well, good afternoon, Nastasia. I think it's fair to say that global sentiment has improved significantly this week on the back of CPI on Wednesday and PPI on Thursday in the US. And we've seen the best week for global equities year to date, up about 3.5%, as well as emerging market equities performing quite well. And so definitely a risk on trade, which can be seen in various EM currencies, as well as with gold holding steady and so on and so forth. So investors are essentially betting that the Fed is close to the peak of its rate hiking cycle, with Fed funds futures implying that we'll get one more hike at the next meeting of 25 basis points. And then the Fed will pretty much take it steady until the end of the year. Even more so, most investors are actually pricing in rate cuts for 2024, with 6 being priced in. So that would take the Fed funds rate back down to about 4% from the current 5.25 or rather 5.5 following the next likely hike. So that is quite a bet, and obviously that has significant implications for asset prices if that were to play out. But of course, the Fed is still signaling that they are not likely to take inflation lightly, if one may put it that way. And so there's a bit of a disconnect between what the market thinks the Fed will do and what the Fed is saying that they will do.
Let's stay with the theme of central banks and bring it to South Africa. How far are we when it comes to this rate hiking cycle in your perspective?
Well, I would say with South Africa, as far as South Africa is concerned, we obviously have seen a strengthening of the rand. It's more to do with dollar weakness, the dollar having weakened against most global currencies this past week. And so obviously those interest rate differentials start to look somewhat better if we feel, or if markets feel that we're close to the peak. And of course, with inflation being lower, we see the difference in inflation parities also moderating. So this is positive for global currencies and EM currencies as well. And we know that the SARB had flagged potential depreciation in the currency as a source of imported inflation, something that they were quite cautious about, and that led to the 50 basis points hike that we saw some time back, and obviously that the market took that quite negatively. So I think going forward, the SARB will still be somewhat cautious, looking at inflation expectations, which are sitting at around 6.5%, so still slightly above their target. So I think we may still see definitely one more hike, but obviously the jury is out on whether or not we will get a second hike going forward from that. But I think given the lag effect with monetary policy, that the SARB and the central banks are likely to wait to see what the further implications are of the hiking that we've seen so far. Obviously, in our situation, the economy has declined somewhat, whereas we still haven't seen significant deterioration in the US economy. So obviously, there's a lot less room to maneuver for the SARB.
Yeah. So we had Absa's trading update, and right now looking at that share price up almost 0.5%. What is your sense of the banks right now? Are we getting to that period where the good times for the banks, because of high interest rates, are coming to an end? What's your view on SA banks?
So I think with regards to the banks, they are under a bit of pressure as far as their performance and what they've been reporting lately. But there are some green shoots, if one will. So with regards to their NIMs or their net interest margins, those are looking slightly positive. So we're seeing a bit of an endowment effect. So most of our loans are floating rate loans. And so as interest rates rise, deposit rates don't have to rise in tandem. And so that lag effect does lead to a bit of a margin uplift for the banks. However, on the opposite side, credit losses are increasing, and so that impacts the credit loss ratios negatively, with Absa this morning saying that they expect for the half somewhere around 1.25 to 1.3%, whereas their longer term or through the cycle CLR is somewhere around 0.8% to 1%. So that is slightly higher than what some of the other banks have reported, but there is quite a bit of pressure on the retail side of the book, and Absa does have quite a large retail book and mortgage book. So we know that the SA consumer is under pressure. So impairments on that side obviously mean more provisions have to be raised, and that obviously has an earnings impact. They've also highlighted that there's some good cost pressures, well, not cost pressures, but good expense controls. And so they expect their cost to income to come down to about 50%, which is very, very positive. And one would assume that the IT spend going forward may not grow as rapidly as it has historically, whereas Standard Bank may, for example, continue to roll out on their IT spend.
Right.
So slightly different strategies there. Yeah.
Tato, unfortunately, we have run out of time, but thank you so much for giving us that update on the markets. However, we did mention that it is U.S. earnings season, and we have a lot of the U.S. banks unofficially kicking us off, the likes of JP Morgan as well as the other U.S. banks. But next week, we kick off as well with the tech companies. We will give you updates on those and digest the numbers in more detail.